Welcome to Stock Informer for You. The noise in the market is loud, but we prefer to let the data do the talking. Intro: The Profit Illusion. If you looked at the headline, earnings results for ICICI Prudential Life Insurance today, you probably expected the stock to skyrocket. Profit after tax jumped a staggering 61% quarter on quarter. Yet today, the stock didn't rally. Instead, it cracked over 3.6%, breaking past critical support levels to trade near the 503 rupees mark, sitting right at the absolute bottom of its 52-week range. Why are institutional investors dumping a company that just reported surging profits? Is this a dangerous value trap or the ultimate buying opportunity? Let's strip away the corporate marketing and look at the exact numbers. Section 1: The Revenue Collapse and Tax Credit Trap. To understand this crash, we have to look at the profitability paradox. Retail investors look at net profit. Big institutions look at how that profit was made. Take a close look at the income matrix. In Q4, ICICI Pru's total income plummeted to just 4,221 crore rupees, compared to the previous quarter's massive 22,591 crore rupees. That is a staggering 81.3% collapse in top-line revenue quarter on quarter. So, how did the net profit rise to 623 crore rupees? Two words: tax credits. The company received a massive tax write-back of 342.57 crore rupees this quarter. Combine that with a dramatic 84% reduction in quarterly operating expenses, meaning they scaled back on new policy commissions and marketing outlays, and you get an artificially bloated bottom line. The market immediately saw through this illusion. Core underwriting revenue has temporarily dried up. Section 2: Technical Breakdown and the Bank Problem. It's not just a fundamental issue. The charts gave us a massive warning signal. Technically, the bears are in complete control. A prominent weekly stochastic crossover turned bearish at the end of May. Historically, when this happens to ICICI Pru, the stock drops an average of 5.6% in the following weeks. The 5-day EMA at 516 rupees and the 10-day EMA at 525 rupees acted as stiff overhead walls, triggering intense algorithmic short selling today. Structurally, the company is fighting a deeper battle. It is trying to break its heavy reliance on its parent company, ICICI Bank, to sell policies. While building an independent distribution network via digital channels and non-parent banks is great for the next decade, it is incredibly expensive right now. This structural transition is capping the value of new business margins and dragging their return on equity down to a muted 9 to 11%. Section 3: The 3-year balance sheet. Outlook. So, where does the company go over the next 3 years? Let's look at the mathematical modeling for our balance sheet projections between now and FY 2029. In the optimistic case, if India's equity markets boom and their new non-bank distribution channels successfully scale up, we project their assets under management to compound at a 15% CAGR, reaching nearly 4.8 lakh crore rupees by FY 2029. High-margin retail term insurance and annuities will push their return on equity up to 13%, making the stock a compounding machine. However, in the pessimistic case, if mutual funds continue to take market share away from insurance products and policy surrenders spike, AUM growth could choke down to just a 6% CAGR, leaving the balance sheet stagnating at 3.75 lakh crore rupees by FY 2029. In this scenario, the valuation multiples will face a prolonged derating. Section 4: The Ultimate Verdict. Buy, sell, or hold. What should you do with this stock right now? If you are a long-term value investor, today's crash has derated the stock to a deeply discounted price to embedded value of 1.4 times. Out of 33 major institutional analysts covering this counter, 27 still maintain a buy with a long-term consensus target price of 689 rupees. If you have a 2 to 3 year horizon, panicking and selling at a 52-week low is illogical. The company's solvency ratio is above 210%. It has zero structural survival risk. This is a slow accumulation zone. However, if you are a short-term momentum trader, do not try to catch this falling knife. The technical damage is severe. The ultimate line in the sand is 488 rupees to 490 rupees. If the stock holds below this level, the next stop could be a slide down to 460 rupees. Avoid buying until you see a definitive daily reversal candle or a pushback above 522 rupees. What are your thoughts on ICICI Prudential? Are you buying this absolute dip? Let me know in the comments below. Hit that like button and subscribe for more data-backed institutional market analysis.